All right, episode 1 here of the Creative Acquisitions Podcast. My name is Dr. Connor Robertson, and this podcast series might be 50 episodes, might be 100 episodes. Not really sure how many it's going to be, but the goal of this is to make a mix of audio and video podcasts to talk about creative acquisitions. And my goal here is not necessarily to interview other people. I've done previous podcasts. You can check out theprospectingshow.com or look that up on Spotify and see you did probably 175 episodes where I interviewed other individuals that were high net worth business owners that were growing their businesses and talked about all things marketing and how they got where they're at and the product that they sell or the service they sell. And I went through that whole process. But the Creative Acquisitions Podcast is going to be a place for me to talk a little bit about what I've done in the real estate space and in the business space, both in the buy and the sell side, how creative financing works, how debt financing works, just standard traditional financing, and how to put all those things together so that you can be successful when you're getting into real estate or business. And the reason it's called the Creative Acquisitions Podcast is at the end of the day, most creative finance strategies allow you to get into real estate for a lower dollar amount than what you ordinarily would get into. And I think that that's important because a lot of you who are in real estate or trying to get into real estate, the thing that you have a difficult time with is the cash on hand component. So let's say you're new to real estate and you say, okay, I want to spend $100,000 because that's the cash on hand you have. The problem is that the path from having $100,000 to finding a deal, underwriting a deal, negotiating a deal, closing a deal, building value in the deal, operating that property, getting someone to help support it, hiring virtual assistants, maybe a property manager or co-host, taking that property and then ultimately exiting that property, that whole process is incredibly challenging to do. And when you look on the internet, there's a lot of people who talk about arbitrage, which is a rent-to-rent model, right? You find a property, you rent it, and then rent it again. And there's not a whole lot of content really on how to go super deep into the short-term rental space when you're acquiring properties. And so my goal from a personal brand standpoint is just to share everything that I've learned in the process. Not to say that any one person has more or less knowledge than the other, but the interesting position that I come from is I've bought properties on my own. I've bought properties in partnerships. I've worked with a bunch of different partners. I've also bought out partners. I've also had the opportunity to buy deals with seller financing, seller carries. I've bought deals with subject to financing, wraparound mortgages, conventional financing, DSCR, bank statement, all the different non-QM products. And so having this really wide approach to buying short-term rentals as a whole and getting into real estate investing, I think if I was in the shoes that I was in 5 years ago, I would want some type of podcast like this that would explain all the steps that someone would go through to get there. And so this first episode, just me kind of rambling about the things that I've gone through and what I think the next 50, 60, 70, 100 episodes of this podcast will look like. And ultimately today, I'm just going to talk a little bit about where I would focus if I was getting into real estate. So just to go backwards, I've come from the digital marketing online entrepreneur space, and I originally was a chiropractor. And before I was a chiropractor, I went to school for a little bit of time. Grew up in Canada, did some education up there, then came to New York, got a chiropractic degree, worked for a couple different people, exited the chiropractic space to come into the online digital marketing space, which was mostly outbound marketing, right? Email marketing, LinkedIn marketing, things like that. And what I started to do is start building a little bit of a brand and started building some reputation online and started delivering a good product. And we went from LinkedIn marketing, outbound marketing for B2B businesses to email marketing to a combination of the two. And then ultimately parting ways with that business and going into other digital businesses. Now, along that way, I was involved with consulting on maybe 8, 9 customers that were marketing customers of mine. And the consulting that I was involved with was exit consulting, helping them package the business in an SOP'd way, a standard operating procedure way that they can actually sell their business and exit, which is one of the hardest things to actually do. There are thousands and thousands and thousands of businesses that never actually sell. And the reason that they don't actually sell is because they don't have systems, process, or anything in place to be a sellable business. So through that whole marketing journey, I learned how to acquire customers. Then I learned how to profitably acquire them so that we were making money on the front end. Then I learned how to build the business, the team, the back end, and how to ultimately get to a spot where you could sell a business. At the same time, I was making a good amount of money and I wanted to use my money in smart ways. Lots of people are out there buying really fancy cars, fancy homes, spending a bunch on jewelry and vacations and trips and things like that. And I decided that, hey, listen, at the end of the day, I need to learn a little bit about the tax system so I can reduce my tax burden. I need to learn a little bit about how to put my money to work. And then I also need to learn about how to foster relationships with other people so that you can grow quicker, but also diversify risk. And so probably the biggest piece of advice I can provide on the front end is it is always easier to do a business, any type of business, when you have a business partner. And although that might be frustrating if you're like super alpha, you want everything done your way, very controlling, I have a difficult time with controlling process. And so that can be a big roadblock when you're building a business. But what I will tell you is that having a partnership when you're buying short-term rentals, long-term rentals, multifamily development, BRRRR strategy, whatever your strategy is, having a partner in that business is very, very helpful. And sometimes having more than one partner, if it's strategic, can make sense too. So what we were able to do is we were able to build this company called Hedge Capital. Hedge Capital takes 50% ownership interest in a bunch of other properties with other partners. And so what happens is we put together this model where I'd work with friends and colleagues, business partners, and people that I've done work with in the past, and we'd find, underwrite, negotiate, and close short-term rentals. It started back, I think, in 2021, and has kind of continued to grow over time. And the interesting thing along the way is that you realize that everybody who's a business owner or a high net worth individual, high W-2 earner at a job, has the same goal, which is mostly their retirement accounts are capped out or they're not eligible for them because of their income. For example, a Roth IRA after $100 and something thousand, you can't use it. And so they've tapped out all their standard investing strategies. They've done some mutual funds, some self-managed work in the stock market. Maybe they own their personal house. And then they go, well, what is next? And for the business owners, they're really, really busy. Same with the W-2s, really, really busy doing their thing that earns their money, that they don't have time to sit down and actually learn how to do this other stuff, right? This other stuff being, how do I buy a short-term rental? How do I buy a long-term rental? How do I get financing? All these different pieces. They know they want to do it. They know they want to get into real estate. They've read Rich Dad, Poor Dad, or they've gotten some start, but they don't know how to actually do the next steps. And so what I ended up doing with all these guys that were exiting their businesses is I helped them purchase real estate. And the reason I helped them with that is they saw what I was doing and wanted to do the same process. Now, one disclaimer here is buying rentals as a whole, short-term rentals, long-term rentals, any type of real estate, you're not going to cash flow in your first couple years. I know there's lots of people out there that talk about cash flow. You're very unlikely going to do that. The first two properties I ever bought were in Charlotte, North Carolina in a partnership, okay, a 1065 partnership. And those properties, from a cash-on-cash standpoint, are probably like 3% cash on cash, maybe 5%. I haven't looked at the portfolio for the year end here, but very, very low cash on cash. We pulled $0 out of the business. It's solvent, it's good, but it hasn't produced a ton of cash flow. What has happened is one of the very first homes I bought with a partner, we bought it for, I think, $404,000 down. $404,000 purchase price with $400,000 down. Wow. Neither of those are correct. Back that up. There's a $400,000 property with $40,000 down, 10%. And ultimately what we did is we bought it with a second home because it was going to be a dual purpose property. We ended up furnishing it for probably another $20,000, maybe a little bit less. So we're in for 40 plus closing costs, call it 50 plus 20, that's $70,000 all into that property for a roughly $405,000 property. Now that property has generated somewhere around $6,000 a month in gross income. And the mortgage's PITI is about $2,000 with all the other expenses, gas, water, sewer, electric, internet, cleaning, CapEx, maintenance, all those different things. We've cash flowed about $1,000 a month on that property. Now, the interesting thing is that within a single year, you can have good cash flow, right? Let's say 6 comes in, 5 goes out, you're left with $1,000. You have $1,000 a month. Obviously, there's seasonality in the short-term rental space. So at the end of the year, you're left with $12,000. But the thing is, you have to keep a bunch of that money in reserve when you start building a real estate portfolio, because at some point, something's going to break and it's going to be worth $12,000. So my lifetime on that particular property right now with a partner, we're probably only up $6,000 in cash flow total over about 3 years, which is a really crappy number. That's 3 and 3, right? 3,000 to me, 3,000 to the partner. And I'll give him a shout out at some point in this video here. But that particular setup if you look at it from a living on standpoint, like neither of us are living on $3,000 a year in cash flow, or $3,000 over 3 years in cash flow, about $1,000 a year. But we have a property we bought where we disposed of about $70,000 in cash, 40 plus some closing costs plus furniture. And the property was $400,000, and in the next year will be very close to $500,000. So it's almost $100,000 in value, which is 2x the down payment. So if you think about that math, regardless if you want to look at the down payment or the total entry, down payment being the 40 grand, the total entry being the 40 plus closing costs plus furniture, which is closer to 70, we've made at least 100% return on our money before selling the asset. Now, at the same time, we have a great interest rate. It's like 4% or 3.5 or something like that. Very, very low interest rate because of when it was bought. But the crazy thing about this deal is that property by 2030 will be a $1 million property, which means that we'll have gone from probably $400,000 asset to $1 million asset, 2.5x growth in a highly appreciated market that's going through heavy gentrification. And so most people are getting into real estate would say, that's kind of crappy. You made $1,000 a year each, over the last 3 years, but you're missing the long game. The long game is at 30 years old now, when I'm 40, right, this property would be close to $1 million asset based on the gentrification and the improvement of the area, which means we'll have $1 million minus about $300,000 in debt, which would be left on the property at that time. So we have $700,000 in equity at 40 years old. I know there's two of us, so it's $350 and $350, but still $350,000 in asset valuation that is being run by somebody else, being operated by somebody else, and is still growing over and over and over again. So the whole purpose of me putting together this series is to talk about the journey, the process, how we got here, how we went through all this. And the one thing I will give as a disclaimer is there are a lot of components to investing in real estate that are securities based. So you need to have some support there. There are some legal items, there's some tax items, there's all these different items. And so before you go super, super deep down the rabbit hole, what I would probably recommend is that you get some advisors that can help you through this process. Because at the end of the day, I have a very bad habit of giving my opinion on these things online, which gets me into hot water quite often. But you need to understand these strategies. You need to understand how the taxes work on real estate. You need to understand how to report your income. You need to understand bookkeeping. You need to understand, how your different businesses or your job and your businesses and your real estate all tie together. You need to learn how to put a plan together for investing. You need to optimize for your taxes. You need to think about, when am I going to sell an asset? How long am I going to hold an asset? What's my retirement goal? Like, you have to have all these things lined up. And if you don't have them lined up, what you're going to find is that you're going to be going nowhere. You're going to have this plan to nowhere, and that's not going to be super effective. So what I would recommend you do is sit down, draw on a piece of paper your exact plan, which hopefully in episode 2, if I don't screw this up, in episode 2, I will put together a plan, and maybe I'll draw it on a whiteboard and show you guys part of the podcast series of exactly what I would do if I was 30 years old and wanted to get to 60. And I'll show the same modeling at 50 years old to 60 to show you how you can build this net worth slowly over time and try to document this whole process. Now, keep in mind, the way that you build your plan, the areas you invest, the type of properties, the size of the property, the type of financing, the method that you use is totally up to you. The thing that's going to kill you is not doing anything. I would much rather lose $1,000 a month in cash flow and own an asset than not own the asset at all. So just keep that in mind. Not every deal is going to be perfect. You're going to make mistakes. You're going to have interest rates that are too high. You're going to buy bad deals. You're going to make mistakes in furniture. You're going to have tenant issues. You're going to have a lawsuit at some point. You're going to have a tax problem at some point. You're going to have an issue with selling a property or buying a property or some legal issue or a title issue. You're going to have a ton of issues as you do this, and the issues don't get easier. You just start seeing the same issues more than once, so you know how to solve them a little bit quicker. And so my recommendation to you is, if you're going to get into this space, please, 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 for yourself, find a good business partner that has good liquidity, that's in a similar situation to you, that's continuing to work. Don't work with people that are relying only on this for cash flow. The reason I say that is if you have two partners and your goals start diverging, right? One person's optimizing for 30 years, one person's optimizing for 10 years. You start diverging, that creates friction, because then the partnership that you're in, working together, you're going to make different decisions based on that. Someone might say, hey, I got a great offer on this house. And you say, okay, well, we're up 150 grand, let's sell it because you're the 10-year guy. But the 30-year guy's like, well, wait a second. Yeah, we might be up a bunch of money, but we could be up way more if we hold it. And we really don't need the money right now. So this kind of split, you got to choose your partners wisely when you do that into the future. And in future episodes, I'll show you the path that I think makes sense for most people to go through. But keep in mind, you have to have your own retirement plan. And the best way to structure, in my opinion, the best way to structure your retirement plan is probably three things, right? You're going to have your primary house as an asset, hopefully. You're going to have retirement accounts. You're going to have real estate. Those are the three things: your personal house, third-party real estate, retirement accounts. Now, you might also have a fourth one, which is income, and you might have a fifth one, which is businesses, right? If you can have all five, that would be awesome, right? You're still making income, you have a business, you have stocks, bonds, mutual funds, right? You have real estate, like you have all these sources, right? That's going to be great. And the reason that's great is because it gives you options, okay? Money gives you options. It doesn't do anything but options. It solves problems and gives you options. And so the general rule of thumb is take how much you want to spend from 60 to 90, which is probably how most people are going to live, maybe a little bit less, but 60 to 90, which is a 30-year horizon. Ask yourself, how much money do you need per year? Multiply it by the 30 years, and that's where you need to end up. So that's starting with the end in mind. So if I want to retire at 60, and I'm going to live till I'm 90, and that's 30 years, right? You can say, okay, I want to have $1 million a year. You need 30 million. Let's say you only want 300K a year. You need 10 million. That's probably more practical, right? So if we say, okay, I want $10 million for those 30 years, that's going to be plenty of money, probably. Maybe inflation gets crazy, but $10 million for 30 years is going to be fine, especially if you can put some of it in the stocks, bonds, mutual fund to continue to grow it, or real estate. So then you ask yourself, out of that $10 million net worth, where does it come from? Is it your primary house? Is it stocks, bonds, mutual funds? Is it real estate portfolio? Is it a business? Is it another source of income? I don't know what it is for you, but you have to draw this on a piece of paper and try to calculate yourself what your net worth is going to need to be and what kind of assets you're going to need. Generally speaking, I think a great approach is to buy homes that are over $500,000 today, okay, and have a disposition, a selling process over the next 30 years from 60 to 90, those are your 30 years of disposition, where you can sell those assets for 3 times more than what you bought them at, okay? So if I buy 30 homes that are $500,000, that's $15 million in real estate. That'll be worth $45 million in real estate over about 30 years. So if you could start at 30 and end at 60, that plan will work. If you're going to start at 45 and end at 60, that's going to be half the time, so you're going to have half the portfolio because time's not on your side, so you're going to sell that. Now, keep in mind, whatever your asset value is, whatever real estate you own at 60 years old, you're not going to sell all of it that year and use it for the next 30 years. You might sell one every 2 years or 3 years and start liquidating the portfolio, or might have paid it off and the cash flow is just cycling really good at that point to help you retire, okay? So your strategy is going to depend on your situation, but remember that homes continue to appreciate over time. Yes, they go up, yes, they go down, but they continue to appreciate. So don't think about your retirement plan as selling all of your assets at 60. Same reason you wouldn't sell all your stock portfolio at 60. You might sell 10% of it or 5% of it per year, right? And it's going to continue to grow, but you sell some, continue to grow, sell some, continue to grow, sell some. Same thing with the real estate. You might sell one asset, take that cash, live off of it for 2 years. You'll have no mortgage payment for your principal house. You might have taxes, insurance, and a car, stuff like that, but you'll be able to have plenty of room to be able to grow long term. So what the first probably 3, 4, 5 episodes of the show will be is me kind of walking you through all the things that you can do as an individual to grow the short-term rental portfolio or the real estate portfolio. We'll talk about commercial, we'll talk about multifamily, we'll talk about some of these other assets, but we'll focus on short-term rentals. And then we'll talk about what the disposition strategy is from 60 to 90 years old so that you can have in your mind what that might look like. And again, I'm not trying to provide you tax or investing advice. What I'm trying to do is share with you a journey and the math associated with growing this over time. You have to be fully committed. You must be fully committed to a process, because if you don't have a path to this retirement plan, you're not going to be able to ever execute anything with success. So you got to be able to write this down. When you listen to future episodes, it's probably good to have pen and paper or take notes on your phone or something like that, so that when you hear some numbers, you can just jot them down and say, okay, I got it. This is good. Let's move on. Okay. And so on the Creative Acquisitions podcast, we'll continue down this pathway here over the next few. I appreciate you guys listening to the first episode. And if you have any questions, you can drop it in the comments below. And hopefully you guys enjoy this journey with me.